Good morning, everybody. Thank you very much for joining me for this morning's SURF webinar. We will be looking at Q1 in review. My name is Denisha Sabji, and I'm a Senior Client Executive in the Johannesburg office of Sygnia. In terms of this morning's agenda, we'll take a look at the April performance to each of the three standard SURF portfolio ranges. We'll then talk around the key economic and macro themes that we pay attention to in terms of positioning as far as our asset allocations go. I'll then show you some of the niche or satellite type portfolios that we continue to invest in order to enhance portfolio returns. And then, of course, in terms of questions, please feel free to type it in the chat box if you haven't already sent them in advance. Stepping on to the April market performance, paying attention to the one-year numbers, you can see that South African Inks delivered double-digit returns, all ahead of 30% for the 1 year ended April. The JSE All Share Swix Index delivered 32.4%. This is what we use in terms of the signature range. And then for the JSE All Share Index, 36%, and the Capped Swix Index also having delivered 36% to the end of April. A lot of this has been coming through because of the commodity rally. We saw resources delivering a staggering 59.8% to the end of 1 year as at April. For the start of this year in January, resources delivered a whopping 90% return. Industrials and financials continue to deliver double-digit returns. We do, however, believe that this is a reaction to market sentiment, and for the next half of this year, we don't anticipate such high double-digit returns coming through as far as the domestic allocation goes within equities. Now looking at South African listed property, 40% over 1 year. It's had a significant comeback compared to a lot of the losses we experienced within that particular sector over most of last year and even before that. You can see over the 3-year time period as well as the 5-year time period, this particular sector continues to deliver negative returns. As far as Sygnia's asset allocation goes, we don't directly invest in South African listed property. It was a decision we had taken almost 3 years ago prior to the outbreak of COVID-19. It was many reasons for us avoiding that particular strategic asset allocation, including structural concerns, growth concerns, as well as stretched valuations. You may recall the resilient stable group of companies, which included Nepi and Rockcastle, that came under pressure around the middle of 2019. At that point in time, we decided not to invest directly into South African listed property. We have been able to protect our members on the downside as far as that particular asset allocation goes, but as you can see for the year end April, this positive 40% has given some of the other peers in the industry an opportunity to recover in terms of their performance because of their property allocations. Now taking a look at South African bonds represented by the JSE All Bond Composite Index, 14.7% over 1 year. It's the best performing asset class, just behind domestic equity, despite the fact that our government bonds were downgraded to junk status almost a year ago. So just after that initial lockdown in March of last year, Moody's, the last rating agency that had downgraded the South African government bonds to junk status, our bonds still continue to deliver real returns in excess of any other returns we're seeing across international bonds. So we still believe in investing within the domestic bonds. Of course, these are not government bonds. These are corporate bonds that are backed up by financial institutes, such as banks and insurance companies. Cash is represented by the STEFI index over 1 year, a 4.3% return. We're at a point now in the market cycle where the defensive asset classes, being cash and bonds, are starting to underperform the growth asset allocations, which are equities. Very different to where we saw ourselves last year this time, where a lot of the domestic equity counters were delivering negative returns, and we saw the defensive asset classes delivering higher returns. But of course, when saving towards retirement fund investing, we want to remember the long-term strategy of the fund, and that's why for those members that are young and have a long investment time horizon before they exit the fund due to retirement, they should be invested in a larger exposure to equity and a lower exposure to the defensive asset classes. When using the default life stage model within the SURF umbrella fund, you are then automatically de-risked into more safe haven type assets as you get closer to your retirement. So automatic protection for members. Then looking at the international exposure. So once again, in terms of Regulation 28 of the Pension Funds Act, over and above investing 75% in the domestic market, we can take up to 25% in international markets. And you can see equity markets represented by the MSCI World Index, when converted to rands, delivered 14.8%. This represents developed economies, and then just below that, emerging markets, 17.5%. So what we're seeing now is that emerging markets are starting to outperform the returns that we're seeing in the developed world. And I'll remind you of our strategic asset allocations with regards to that within the next while. And then, of course, we can also invest in cash and properties on the international allocation. To the end of April, we saw the rand depreciating against the US dollar, down 21%. We are starting to see a recovery of the rand against the US dollar today, trading at around 13 rand 75 cents. It's the best performance the rand has delivered in the past 2 years. Now taking a look at the fund-specific performance, starting with the 70 range. This is the most aggressive type allocation aimed at members that have well before 6 years of reaching their retirement age. Paying attention to the 1-year number, you can see those stellar double-digit returns coming through for Signature 70 at 22.4%, Skeleton 70 having delivered 21.4%, and Synergy 70 delivering 25.1%. Each of those portfolios were above the strategic benchmark at that point in time. Just a reminder in terms of the different investment philosophies of the portfolios. So Signature 70 is the blend of active and passively managed investment philosophies, whereas Skeleton is purely the passively managed fund. Synergy is the blend of active balanced mandate, and within that particular portfolio we make use of some of the larger single managers within the South African investment climate in order to invest across the domestic asset allocation. Then looking at the moderate portfolio, Signature 60 delivered 20.2% to the end of 1 year, ahead of that strategic benchmark of 17.4%. Skeleton 60 had delivered 19.3%, and then Synergy 60 coming through at 21.5%. Quite stellar returns, considering the fact that 2020 was a very unprecedented economic market cycle. And if we looked at the returns a year ago, 30th of April 2020, we did not necessarily see such significant double-digit returns. Our portfolios have been able to navigate through a lot of that volatility and continue to deliver these positive, stable returns across each of the risk spectrums. Signature 50 to the end of 1 year, 17.9%. Skeleton 50 just behind that at 17.5%. And then Synergy 50 at 18.6%. You can notice on the Synergy range of funds that some of the active managers starting to deliver positive performance, mainly because of the fact that some of them did have an allocation to property, and we're starting to see that particular sector recover in the short term. As far as the conservative portfolio goes, Signature 40, 15.8%, Skeleton 40, 15.1%, and then Synergy 40 at 15.7% to the end of 1 year, ahead of that strategic benchmark of 13.4%. Considering the longer term track record, so over 5 years, you can see that the portfolio's still ahead of the strategic benchmark for each of the different ranges. However, the returns are more moderate, strong 8% coming through for Signature 70, and then for Signature 40, you can see an 8.3% return. That was mainly because of the fact that we did experience a difficult equity climate over the past while, and this is where we saw the defensive asset classes such as cash and bonds delivering better returns compared to the domestic equities, and that's why the more moderate portfolios delivered slightly higher returns compared to the more aggressive portfolio. Now taking a look at the peer group performance, and we are looking at the surveys to the end of April, you can see that Signature 70 along with Synergy 70 and Skeleton 70 delivered returns in excess of the global large manager watch median. You would recall that this is the average return of all of the managers that qualified for the survey to the end of April. Familiar names such as Allan Gray, Coronation, Prudential are featured. 91 is the new name for Investec Asset Managers, and we continue to deliver returns in the top performance among some of these single managers. So now let's take a look at each of the different ranges, starting with the low equity multi-manager survey. This is where the 40 range of funds feature. So you can see Signature 40 at 15.8%, Synergy and Skeleton just behind each other. Over 1 year, our funds continue to deliver returns in the top 11 positions. What's very important to note is that some of the managers that are now starting to appear as though they have outperformed over a 1 year period were performing very differently this year last time, and some of them even sitting in negative territory. That implies that they had a much lower base to recover from. In terms of their asset allocation, some of them were overweight South African equity, slightly different to our investment philosophy at Sygnia, where we are currently underweight domestic equity. And then, of course, I've mentioned the fact that we have no allocation to local property. So we are starting to see some of the peers recovering over the short term because of those differences in investment philosophies. However, the Sygnia portfolios continue to perform well in this low growth, high volatility environment, and our performance continues to remain stable and consistent across the various time frames. That's why we're showing you the 15-month number. So a quick snapshot of where the portfolio's positioning existed before the outbreak of COVID-19 within South Africa, and this becomes more comparable because you can see that our portfolios continued to deliver returns ahead of some of the peers that are now appearing as though they've done better over 1 year. And then as we go through it, you'll see that the portfolios continue to deliver consistent, stable returns for the members. And ideally, that is very important because we want to be sure that the strategic long-term allocation that we are using within the portfolios are able to navigate the various different market cycles, and our members continue to experience the best possible returns. So let's pay attention to all of the red lines for the 15-month period, the 2-year period, 3 years and 5 years, 7 years and 10 years. You can see over 10 years, we've got fewer managers that appear in the lineup purely because not all of the managers have such a long-term track record. Over 10 years, Signature 40 has delivered double-digit returns, 11.8%. Skeleton, which is our passive mandate, just behind that at 10.8%. And then over the 7-year track record, our portfolios have taken the first, second, and the fourth position. Now taking a look at the low medium equity range, this is where the Synergy, Signature, and Skeleton 50 funds feature. Once again, you can see us delivering returns within the top 10 rankings to the end of 1 year. Over 15 months, Skeleton 50 delivered 11.9%, whereas Signature 50 was just behind that at 11.8%, and Synergy 50 coming through at 10.7%. Over 2 years, you can see 9.7% for Signature 50, 9.6% for Skeleton 50, and then Synergy 50 coming through at 8.4%. Over the 3 and 5 year period, our funds continue to be within the top 5 positions, and over 5 years you can see strong 8% returns coming through across each of the ranges. And when we get to the 7 and the 10-year track record, Signature 50, 9.3%. To the end of 10 years, Signature 50 delivered 11.5%. Note that once again, there are fewer managers to compare with that long-term track record. Now taking a look at the 60 range of funds. So Synergy 60 to the end of 1 year, 21.5%, Signature 60 at 20%, and Skeleton 60 at 19.3%. Over 15 months, Signature 60 was the best performer, having delivered 13.3%. Skeleton 60 just behind that at 12.7%, and then Synergy 60 at 12.3%. Just out of interest, you can see 27.4, their CPI plus 7 mandate was at 12.7% for 15 months, and now they are featured at around 23.6%. So just an indication of these managers starting to recover off that slightly lower base that I did mention earlier. Over 2 years, each of the Signature, Synergy, and Skeleton 60 range funds have delivered returns as the top 3 compared to other peers in the industry. And then the same is true for the 3-year and the 5-year number. Over the 7 years, Signature 60 was the best performing manager, best performing fund, I beg your pardon, 9.4%. And then we've got our Synergy 60 and Skeleton 60 funds just behind that in 3rd and 4th place. And then over 10 years, we were the best performing mandates across compared to peers within the multi-managed space. Now comparing ourselves to the single managers out there. So of course, within the Signature and the Skeleton range, we do use a multi-managed approach. So over and above just using in-house portfolios within Sygnia, we blend the investment philosophies of some of the single managers out there. Here we compare ourselves to those managers. We've got a new entrant into the portfolio to the end of 1 year, Old Mutual Multi-Managers Max 28. They delivered 30.8%. You'll see that there is no longer term track record for that particular fund. And then over 1 year, Synergy 70 delivered 25.1%. We've got Old Mutual Managed, Stanlib, Sanlam, and Momentum appearing as the top performers. Once again, this is the difference in investment philosophies and also an allocation to property to the end of 1 year. Then if we take a look at ourselves against the single managers over 15 months, Synergy 70 was the best performer, delivering 14.3%. Just behind that was Signature 70 at 14.2%. And then if we just compared ourselves to the Momentum Classic 7, you can see over 1 year, 25.4% compared to the numbers prior to the outbreak of COVID, you can see 7.9%. So quite a lot of distortion coming through over that 1 year number in terms of performance from some of the peers. Over 2 years, once again, Signature 70, 10.5%, Synergy 70 at 10.3%, and then Skeleton, which is the purely passively managed fund, coming through at a strong 10%. Over 3 years and 5 years, you can see that our funds continue to deliver returns in the top 5 and 6 positions. And then over 7 and 10 years, we do manage to outperform most peers at that point in time. Now taking a look at this particular graph, it's what is referred to as a volatility versus return scatter plot. What we're trying to illustrate here is that despite the level of risk that our portfolios have taken, we are quite comfortable with the level of return that it has delivered. So just taking a look at Synergy 70 and Signature 70 in terms of the risk measurement, here we use standard deviation, close to just 9.5%. However, our funds have been able to deliver the highest possible returns compared to some of the peers in the industry. So just below Signature 70, you can see the Alexander Forbes Forbes Investments Performer Fund, even the 27-4 fund or the Sanlam Multi-Managed Fund, similar in terms of risk taken on, but very different in terms of the return profile. So we are quite comfortable that our portfolios continue to deliver an optimal level of return for the risk that we have taken on. And ideally, that is what we want to focus on, because when saving for retirement fund investing, we don't necessarily want our members to be in too much of a volatile environment. Now stepping on to some of the key macro and economic themes, and we will take a look at where we were at the start of the quarter, and then just take a look at how it ended up towards the end of March, and even some further updates to the end of May. So sadly, but not unexpectedly, COVID-19 did not end with 2020, and it continues to remain one of the primary concerns this year. Although 82 million vaccine doses were administered across 59 countries at the start of this year, the virus continued to remain one step ahead of all scientists that were working around the clock as the new variants continue to pop up in different geographies. This is Dr. Anthony Stephen Fauci, and he's the National Director of Health and Infectious Diseases within the USA. And at the start of the year, he had initially said that in order to attain herd immunity, we needed to vaccinate close to 70 or 85% of the population. At the beginning of the year, he believed that that was possible for the US population, and that would have hopefully allowed for some sort of a return to normal. However, now based on the global vaccine rollout rate of only 6 million doses per day, it will currently take the world around 5 years to reach that some sort of return to normal. The first 3 vaccines that became available were from Pfizer, Moderna, and Oxford AstraZeneca. The AstraZeneca vaccine was initially costed at around $4 per jab, with the Johnson & Johnson and the Sputnik vaccines coming out at around $10 each. Today, the vaccines are being offered free of charge by governments worldwide. At the initial vaccine rollout, markets rallied over 10%, with the Dow Jones topping 30,000 for the first time in history. February saw the best market upswing since the 1930s. We saw the S&P 500 up from 75% compared to its COVID lows. Unfortunately, the risk of new variants and the delays in vaccine rollouts had become secondary concerns, and the number of global cases started to appear to drop quite dramatically, mostly due to the fact that strict lockdown measures were in place at that time. We then believed that a lot had to do with the lockdowns and not necessarily because of the vaccine rollouts. However, at the start of March this year, we then saw the third wave of infections across Central and Eastern Europe, and new lockdown restrictions being introduced across countries such as Italy, Hungary, and Estonia. Now in May, South Africa has entered the third wave of infections, with almost close to 3,000 new cases being reported by the health department across provinces. Joe Biden was inaugurated as the 46th president of the USA on the 20th of January. He immediately started work by signing 15 executive orders on the first day as a notable start towards dismantling Trump's legacy. During the first 100 days of him being in office, the US markets did the best they ever did under any previous US president. Biden's immediate focus was to pay attention to the American Rescue Plan, and we've seen the largest stimulus package coming out in history, close to $1.9 trillion, which is designed to support the US economy through the pandemic and even after the pandemic. He also started initiating quantitative easing. They basically writing cash checks to each of the US citizens close to the amount of $1,400, trying to get them to go out and spend within the economy. This graph is showing you an indication of the current fiscal stimulus size as a percentage of GDP now under Biden's administration, and it's the largest we've ever seen compared to the global financial crisis experienced in 2008. Just behind the US is Germany and Japan, and then countries coming through Canada, China, and France. So the world is currently operating on this artificial stimulus measure. The reality is that fiscal stimulus is just a means of borrowing from the future, and at some point you have to start paying down the debt. Over and above the quantitative easing, the Federal Reserve Bank also committed to keeping interest rates near zero, despite inflation likely to start to peak over the next year. This will, however, allow real yields to remain low, and it makes it much more attractive for investors to buy bonds elsewhere in the world, except for the USA. So that means that going forward, the US dollar is likely to remain weak, which is quite good for emerging markets as well as for commodities. We are now getting to a point where President Biden's policies are starting to become a bit more balanced. He has made plans to start funding the additional stimulus packages by raising US taxes. The chart on the right shows relative to history. If you go back to World War II, taxes have been slightly higher. Capital gains tax is now currently at its all-time high, and corporate tax is still relatively low compared to that of the last 20 years. So it's certainly going to have an impact on growth in the US and an impact on the stock market, all of which will start creating winners and losers in the developed market and start to create headwind risks, which will in fact be quite good for the rest of the world and for emerging markets. Currently, our Sygnia portfolios are underweight the US in terms of the MSCI allocations, which make up 2/3 of the US. China continues to be one of the biggest driver of growth, and it has to remain one of the cornerstones of any emerging market portfolio. Chinese GDP grew 6.5% in the last quarter of 2020 and is set to be the only G20 country to achieve positive growth this year. Their economic activity surged in the first 2 months of this year. Exports soared 61% in dollar terms, reflecting strong global demand, and imports climbed 22.2%, highlighting this divergence in the economy as the demand for iron ore and crude started to slow down and imports of high-tech parts accelerated. You will recall that China was the first to go into lockdowns because of COVID-19. They were also the first to recover from the lockdown. And since then, in terms of their vaccine rollout, they are doing much better compared to the rest of the world. They will have close to 60% of their population vaccinated perhaps by June of this year. This emerging market is also being driven by the commodity and manufacturing rebound as a consequence of the largest global fiscal support in the past 2 decades, the weaker dollar due to the low US interest rates, and of course the strong global trade due to a more collaborative US foreign policy that is coming out from Biden's administration. In February, copper hit 10-year highs. It's the highest level we've seen in the past 9 years on the back of a lot of the optimism around the global recovery as the vaccines for COVID-19 started to be rolled out. China has also announced its 14th five-year plan. It has a dedicated section for technology development with a clear objective of self-reliance for the country. The plan lays out 7 technology research areas of focus, including artificial intelligence, quantum computing, semiconductors, and space exploration. Premier Li Keqiang said that China would increase research and development spending by more than 7% a year over the next 4 years in pursuit of trying to find the next major breakthrough in technology. They're doing everything that they can in order to open up their economy, and they're trying to be the next Silicon Valley. Over and above the technology focus in their five-year plan, they are also planning to keep their major economic indicators within an appropriate range. They are planning to increase the life expectancy of the Chinese citizens by at least 1 year. They want to raise urban residents to 65% of the population, and they want to pay attention to ushering in a new stage in building a more peaceful China. We've also started to see an increase focus on regulation within China's antitrust regulator. Over the past quarter, we saw fines being issued against some of its largest tech giants, including Tencent. Alibaba, China's largest e-commerce operator, has been asked to dispose of its media assets and is planning to offer its bargain services on rival Tencent Holdings' WeChat platform in a major concession to regulators seeking to crack down on monopolies. And then if we come closer to home, unfortunately for us as South Africans, the new year started amid continued stage 2 load shedding, crumbling water infrastructure and COVID curfew restrictions, as well as continued confusion around the vaccine rollout plans, mostly because there weren't any very clear plans evident. Both South African breweries and Vinpro, which represented the wine industry, were taking government to court over the contentious alcohol sales ban, which was in fact for the third time. The liquor industry supports roughly 1 million jobs, and fears of another jobs bloodbath across the value chain existed, not without any reason. Despite being the shortest month of the year, the South African calendar was jam-packed in February, with the President's State of the Nation address and then Finance Minister Tito Mbowene's much-anticipated budget speech. National Treasury also finally released its draft amendments to Regulation 28 and is now starting to allow for infrastructure to be allowed within as a separate asset allocation for pension fund investing. They've also split out hedge funds as well as private equity into separate asset classes. Our debt to GDP ratio has reduced from the initially anticipated 95.3%. It's come down to around 88.9%, purely because of the 100 billion rands of extra revenue due to the commodities rally that we saw at the start of the year. This renewed revenue collection allowed our finance minister to put forward a budget for the people with tax relief for individuals. It was the first we had seen of this in 6 years. We also saw an above inflation 5% increase in terms of personal income tax brackets. The good news for companies was that South African company corporate tax rate will change or be reduced to 27% from April next year. The budget was very bond positive. Even though the debt will still peak, it will be lower than that which was initially anticipated. During March, we also saw the preferred bidders to provide energy power to prevent load shedding being announced. However, each of them came with their own concerns. And aside from Eskom's spiraling debt, fading sales, and continuing ailing power stations, the utility faces another unsustainable predicament. There is growing concern that a lot of the senior executives are facing serious allegations of corruption and they are being taken to task for underperformance. So currently close to over 3,000 of Eskom's staff compared to that workforce of over 44,000 facing disciplinary action. And then along with other emerging markets, we are behind our vaccine rollout. At the start of May, just over 300,000 of the South African population had been vaccinated. This compares to North America, close to 30%, and then Europe, close to around 25%, South America, which is at about 10%. The world was at an average of just over 1% compared to South Africa at 0.4%. So to date, Africa has only actually received 20 million vaccine doses, which represents 2% of the global supply. We have a very long way to go before we actually start reaching herd immunity. The rand is doing well because of the weak dollar and the global stimulus, which has pushed up commodities, but we do expect this to taper off by the end of the year. So at the start of the year, we still believed that the Japanification of developed markets continued to be a top-of-mind risk, and we named our top 4 investment picks with their over and underweight positions. Starting with the first pick, it was healthcare. Over the most of last year, billions and billions of dollars were being pumped into research and development for pharmaceutical companies and healthcare facilities in order to find a vaccine for the COVID-19 pandemic. Not only has this resulted in some phenomenal vaccines in a very short time period, but we were also likely to see some new medicines being discovered as well, accidentally in the process, very similar to the way in which penicillin and LSD was discovered in the past. The World Health Organization had also put out a report at the start of the year saying that we were seeing an acceleration of infectious diseases. So along with the massive amounts of government support for new medical breakthroughs, healthcare has to have a place in a portfolio as a structural growth asset. Another reason that we got into the sector a while ago was because of the demographic support of aging populations that we believe will certainly drive an increased spend in healthcare. We have balanced this with an underweight to the FANG portfolio. On this chart of the USA, the top line is the top 5 shares of the S&P 500, which is Apple, Amazon, Facebook, Google, and Microsoft. These 5 companies have nearly outperformed the rest of the 495 shares, which is the dark purple line that you see right at the bottom, by almost 50%. As a result, we did believe that the valuations were quite stretched in those stocks, and we were also quite correctly concerned about the numerous catalysts that could overhang those 5 stocks, like antitrust issues, privacy concerns, and tax issues. Now, under the Biden administration, all of those initial headwind risks are starting to materialize. Secondly, on the income allocation, we were and we continue to be overweight South African bonds and underweight international bonds. On this chart, the horizontal axis gives you the term, which is, so taking a look at cash with a term of 0, effectively up to 30 years. On the very right-hand side, gave you which is 30-year bonds. The vertical line gives you the yield or the interest that you earn on that. So over the last 30 years, on average, which is the light purple shaded area, cash gave you nearly a 10% return with virtually no volatility at all. So you could invest and get a 10% return, and you basically had no risk over your capital. You could invest 10% in cash, or you could go all the way out here to the far end of the yield curve and invest in bonds. And here you were getting close to around 11%, but with huge risk. And the further you come out of this term structure, the more the duration increases and the more the volatility happens to your investment. So yes, if you were holding the bond for 30 years, you would get your money back, but within those 30 years, you could have huge swings as interest rates go up and then interest rates come down. So over the last 30 years, if you did any sort of quants modeling or optimization, all the models were saying that South African government bonds are a terrible place to be in, and you were not going to get any more return than cash. However, you would experience a lot more risk. Now within South Africa, we are at a very, very different environment. Cash, as you can see, has given you just over 3% returns. And if you go relative to the far end, 15-year bonds, we were getting around 11%. Now it makes more sense to get invested in the term structure, take on some duration risk, and earn 11% with some volatility. That is exactly why we have switched as much as we can out of our income and our cash allocations into local bonds, and we continue to avoid global bonds. The Japanese 10-year bonds are close to 0, the German 10-year bonds are negative, and the US 10-year bonds are also close to 0. Compared to South African bonds, we saw a 17% return to the end of April. So as a foreign investor, you could hedge the currency and you could get a comfortable return in dollar terms. The third pick was a regional allocation. So we remain overweight emerging markets and underweight the US. We were concerned about the high valuations in the US, a weaker dollar, which translates into weaker returns in rands, and then, of course, COVID, which continued to be a struggle within the developed market. At the same time, there were some good tailwinds to emerging markets with close to $4 trillion of global liquidity being pumped into the markets this year, double the amount of fiscal stimulus that we had seen since the global financial crisis, strong global trade under Biden's administration, and the rise of the Asia emerging market middle class, all leading to very strong growth in emerging markets throughout this year. The other thing that we looked at was this table to consider what had happened historically to the stock market during various US elections. So the horizontal line looks at all elections, when the Democrats win, when the Republicans win, and then the most important is when the Democrats overturn the Republicans. So this is exactly what has happened now. We've seen Joe Biden push out Trump, and we can take a look at the performance since 1988 for the S&P 500. It's the average over the last 30 years. So within the election quarter, you can see a negative 9% return coming through on the S&P 500, but within 4 quarters after the election, a significant recovery of around 15.3%. So that's giving you a return of a positive 5%. All of these are saying that after a US election, you want to be long equities. And then if we look at the MSCI for emerging markets as the average over the last 30 years, you can see also struggled prior to in the quarter of the election, but then within the 4 quarters after the election, a whopping 72.9%. Definitely saying that what you want to do is you want to be allocated to emerging markets, because after the outcome of an election, you can see that history has proven a more significant return as far as emerging markets have gone. And that's true as we see it now. Of course, we don't anticipate a 73% return coming through, but we definitely believe that with all the catalysts currently in play, emerging markets, which have been so flat over the last decade, and the current tailwind risks that we are experiencing to growth, will allow these markets to rise without too much of stretches in terms of valuation. And then for the value investors, so this chart looks at the past 40 years. It shows the NASDAQ 100 over the Russell 2000. So that's technology versus small caps. And it also shows the Russell 1000 growth over the Russell 1000 value. So you can see here that tech and growth were quite correlated, peaking in Y2K in 1999 and 2000, when we had growth peaking against value and we had tech peaking against any other sector. And then we came to 2020, 2 decades later, driven by a similar concern, tech forced up by COVID into a hyperbolic movement. We had tech and growth outperforming value and the rest of the market. It has turned, and it may not come back to all the way like it did in the past, but certainly the growth story has peaked. And that's very likely to continue, because as the vaccine rollout for COVID-19 continues, we aren't ever going to get back to the old normal. People are going to continue to work from home and travel less, so the oil prices may not necessarily be what they used to be, and there's certainly going to be a focus on manufacturing versus services. So as this unwinds, we expect the premium to unwind, and we do expect to start seeing value recover slightly. The portfolios at Sygnia currently use an overweight value tilt through our global property exposure. We remain underweight local property, and we like global property not only because it is a value stock, but also because it has structural growth elements to it. We are invested in specialist industrial sectors, including cell phone towers, data storage facilities, all of which are seeing a strong demand, whereas locally property has got severe headwinds. It is looking incredibly cheap at the moment, and the yields are very exciting. But before COVID even began, we had issues around premiums in South Africa with local companies buying their own stocks, and then pyramid structures, and then, of course, a secondary crisis with too much of supply as COVID began. So even when we get past the pandemic, we still believe that there will be a structural oversupply of property within South Africa in the majority of sectors, and that is why we continue to avoid that particular sector. Taking a look at the asset allocation at the end of the first quarter, you can see that technology, healthcare, as well as emerging market themes remain intact with a strong focus on ESG overlay. ESG is environmental, social, and governance considerations, and we want to ensure that the companies we invest in are sustainable and impact on the world around them positively. The local only satellite is unlisted credit or infrastructure. It's a very nice fifth wheel to have in any portfolio because the returns are uncorrelated to that which you receive from local markets, including equities and bonds, and they do very well when companies aren't thriving as well as they should, which is currently what we expect from the local market going forward. It is also a very nice avenue to invest in government's infrastructure projects as and when the correct opportunity arises. The FANG allocation has been replaced by the Fourth Industrial Revolution Fund, which tracks the Disruptive Innovation Index and invests in sectors such as electrical vehicles, autonomous technology, genomics, all kinds of futuristic trends. It also includes exposure to artificial intelligence, robotics, solar power, space exploration, drones, nano and biotechnology, as well as 3D printing. The fund itself makes use of over 380 different companies. It's very well diversified, and no single holding exceeds more than 4% of the fund. To the end of April, this represents the top 10 holdings, and you can see a lot of different companies all playing across very different sectors, different geographies, and very different focuses as far as the sustainability of those companies go. And then just to remind you of our portfolio structure, you do know that we make use of the tactical asset allocation overlay as a risk mitigation tool, paying attention to South African equity within the 70 range of funds. You can see that we are still slightly underweight that allocation. Within South African bonds, we are overweight. It is the best performing asset class just after equity. South African income and money market, we are still underweight in terms of that allocation. And this is because of the fact that we saw the South African Reserve Bank cutting interest rates 5 times last year as a fiscal response to the COVID-19 pandemic. We do anticipate that perhaps if the Reserve Bank does plan to increase interest rates later this year, we could then make tactical shifts to correct this underweight position. Our largest overweight is to global equity. We should be at around 22% for the 70 range of funds, currently close to 28%. This represents our exposure to the medical and health theme, as well as emerging markets and technology, as far as that Fourth Industrial Revolution Fund goes. And then for global bonds, you can see underweight, no allocation whatsoever because of the distortion in the value due to quantitative easing. I've mentioned the likes of the German bond in negative yield, US close to zero, Japan close to zero. And then as far as international cash goes, we are currently underweight across all of the risk range portfolios. You can see overweight 3.1% for the 70 range, and then for the 40 range, overweight 6.1%. Within this particular allocation, we do also make use of hedges for the rand. So when the rand does appreciate compared to the US dollar, we do then have protection on the portfolio due to the currency fluctuations. And then, of course, we do have additional liquidity in the portfolio as and when we need to change these tactical asset allocation positions. So that's the end of the presentation. I thank you very much for your time. I'd like to take a look to see if there are questions or comments, anything that's been raised by the panel. So I do have one question with regards to the direction of the rand, and do we believe that fair value will be lower than 13 rand? So initially we did anticipate that fair value of the rand was probably around 15 rand 50, but when you do have a risk on environment, you tend to overshoot fair value, and that's why we could expect it coming down to around 14 rand 50. Today the rand is trading at around 13 rand 75 cents to the US dollar, and that's mainly because of the commodities rally that we continue to see. We do believe that it is short-lived and that it won't necessarily continue for the rest of the year. There are no other questions. I do thank you for your time, and if there's anything else you'd like to know with regards to this webinar or questions in general or suggestions for topics for any of our future webinars, please feel free to reach out to us. This recording will be available on our website by next week. I appreciate the time and I wish you all well. Have a fabulous day and continue to stay safe. Take care, everybody. Cheers.